we're going to learn about various methods for valuing interest rate swap. So let's start. Valuation of interest rate swaps using the discount rate. So how to go about with discount rate and what discount rate is being used. So the value of this interest rate swap is determined by discounting each cash flow back to the valuation date. Usually the rate used is the either implied by forward rate agreement or the convexity adjusted euro dollar futures are used to produce LIBOR spot curve, and this swap cash flows are discounted using corresponding spot rate from this curve. There is a whole different concept that we'll talk about. And here the formula is given by R forward is equal to R2 plus R2 minus R1 into T1 divided by T2 minus T1. So here T1 is time 1, T2 is time 2, R2 is spot rate corresponding to T2 years, and R1 is spot rate corresponding to T1 years. So R forward can be calculated by using this formula. This will be used in calculating the rate for forward rate agreement while valuing interest rate swap using FRS. So coming to valuation of interest rate swaps, valuing it using bonds. See, there are two methods of valuing interest rate swaps. One is using bonds and other is using FRAs. So here we are going to learn about how to use bonds to value interest rate swap. Consider a interest rate swap agreement with X and Y, company X and company Y, where company X receives floating rates and gives away fixed rate, and Y receives fixed rate and gives away floating rate. So if you denote first leg payment sets B fixed and the present value of floating leg as B FLT, the value of swap can be written for both X and Y as, for X it is B FLT minus B fix, for Y it is B fix minus B FLT. Okay, so while valuing a bond using valuing a swap using a bond, we need to keep in mind that for the floating bond that we are going to value, we will be only taking the next floating payment, not all the floating payment that is yet to come. The next floating payment is taken and added with the notional principal, which is equal to the bond value, and it shall be discounted and brought back to the period that we are going to value our swap. So that is the basic idea behind valuing our swap using a bond. So here value of swap is equal to value of fixed bond minus value of floating bond. We can value the fixed rate bond using spot rate curve and then discount next non floating rate payment plus notional amount to the current discount rate. So floating rate bond is only valued from the next date, and it is being brought back to our period in which we wanted to value our swap. So that is a basic idea, and that is a point that we have to note in this. So we'll consider an example. So consider an example of 1 million notional swap that pays a floating rate based on 6 months LIBOR and gives 6% fixed rate semi-annually. Swap has remaining life of 15 months and pays at dates 3, 9 and 15 months. Spot LIBOR rates are as follows. 3 months is 5.4%, 9 months is at 5.6%, and 15 months is at 5.8%. The LIBOR rate at the last payment date is 5%. Calculate the value of swap to the fixed rate receiver using the bond methodology. So this is the question. If you want to read, please pause and read it. So the answer is, first we will calculate the bond fixed using the genuine method that we use for our bond calculation. So we will take all the cash flows, that is 30,000, which is nothing but 1 million into 6% semi-annually for 3 periods, that is 3 months, 9 months and 15 months, and we'll discount it back using the 3 months LIBOR rate, 9 months LIBOR rate and 15 months LIBOR rate. So that is being done here, and at the last principal is also brought back to the current period using that 15 months LIBOR rate. So it gives 10,18,316 as the value of the fixed bond. So we'll have to value the floating bond. So floating bond is, this is a tricky space where the floating bond, all the three payment up to the maturity of this bond in this swap is not calculated. Only the next fixed floating rate payment, that is 1 million into 0.5 by 2, which is the rate last known LIBOR payment, is brought back to the current period. So it is like 10 lakh, which is the notional principal, plus the interest is being calculated using the last payment date interest rate, that is 5%. So interest is being calculated, that will come around 25,000, and this 25,000 plus 10 lakh is added and brought back to the period to now by using the 3 months LIBOR rate. So that gives a value, and this also gives us a value. So value of swap is equal to bond fixed minus bond floating. Since the value of a swap is fixed, B fixed minus B float, so which gives 10,18,316 minus 10,11,611, which is equal to 6,705. The characteristic, the basic thing that we need to note is this floating bond will not be valued up to the maturity, but only the last interest rate payment will be taken and brought back to the current period using LIBOR rate of the next interest payment, which is 3 months interest payment. So that's how we value an interest rate swap using a bond. Valuation of interest rate swap, valuing an interest rate swap with FRS. So we can see that the interest rate swap is equivalent to a series of FRS. This is being said because if you know about the FRS, that is the forward rate agreements, what happened is at the end of a forward rate agreement, the fixed rate will be the rate fixed as the agreement, and the variable rate will be the rate that is pertaining to the market, and net settlement of both the rates happens at a notional principal. So this is what happens in the case of forward rate agreements. If you take forward rate agreement, it is like a periodic settlement of interest rate swap. In interest rate swap also, we will do the net settlement of what is in the market and what is agreed upon, or the floating and fixed. So the difference between that is net settled between the parties. So an interest rate swap can be viewed as a series of FRAs up to the maturity. So one way to value the swap would be to use expected forward rate to forecast the expected net cash flows and discount these expected cash flows at a corresponding spot rate consistent with forward rate expectations. So that is what we are going to do when we value interest rate swap with FRAs. We'll take an example. So considering the previous example of valuing interest rate swap with two bond positions, an investor has 1 million notional swap that pays a floating rate based on 6 months LIBOR and receives 6 months fixed rate. So fixed rate is 6% and 6 months LIBOR is taken. 3 months and 6 months 15 days 15 months swap period. So spot rates are 3 months 5.4, 9 months 5.6 and 15 months 5.8. The LIBOR at the last payment date was 5%. Okay, so calculate the value of swap and to the fixed rate receiver using FRA methodology. Okay, so as here we have they have given that last payment was 5%. So the floating cash flow for 3 months would be 25,000. That is 5% into 1 million divided by 2 because it's for a 6 months period. So that's taken, and for fixed days cash flow will be at 6%, that is 30,000, 30,000, 30,000, 6% of 1 million divided by 2. So then we'll have to find out the next two cash flows at 9 months and 15 months. So for that we'll have to use the formula R forward is equal to R2 minus R2 plus R2 minus R1 into T1 by T2 minus T1, where R2 is rate at the time 2 and T2 is time 2, R1 is rate at time 1 and T1 is time 1. Okay, so R forward is equal to 0.056, which is 9 months forward rate, plus R2 minus R1 0.056 minus 5.4 into 0.25, which is 3 months period, that is 3 months divided by 12 into 0.75 minus 0.25, 6 months minus 3 months, 9 months minus 3 months. so which gives 5.7 percentage. So 5.7 percentage of 1 million divided by 2 is 28,500, and similarly we will calculate for the 15 months, which comes around 6.1 percentage, and our cash flow will be 30,500 based on 6.1 percentage. So we'll be using discount present value factor of this, and uh, this will find out the present value of fixed cash flow and floating cash flow, and the difference will be the value of the swap. Okay, so that is being done for finding out interest rate swap value using FRS. So this is how we value FRS using interest rate swap. It's pretty straightforward. Takes fixed cash flow, find out floating cash flow using this formula, and discount using our interest rate, our present value factor interest rate of present value factor of our interest rate, and find out the present value of cash flows. And FRA value of the interest rate would be the difference between fixed rate cash flows, present value of fixed rate cash flows minus present value of floating rate cash flows, which is pretty straightforward. Thanks guys, thanks for watching. Kindly comment if you don't like the video. If you like the video, please like, share and subscribe. Thank you.